Hey guys, hope you are doing well and welcome to another new video, and this is Arman Niloy. In our previous video I talking about everything the banks don't want you to know about the loan and insurance industry. Today I talking about know the risk before entering the loan and insurance industry. So guys, I hope you guys enjoy all the video, and if you guys enjoy the video but you do not subscribe our channel yet, please pay the subscribe our YouTube channel, get more video like this. Okay guys, let's start this video. We see that some risk. The first risk, one, financial risk. Before any financial institutions grants a loan to any SME, is must consider the financial risk involved in the client business or sectors with regards to the loan to be guaranteed. These financial risks include the number 1 point, the client relationship with other financial institutions is necessary in order to avoid multiple borrowing. It's important for microfinance institutions to liaise with the credit bureau within the country is properties to have accurate data. The number of 2, loan purpose. The purpose of a loan is very important since it's prudent for a business to invest loans in current trade, other trade, new projects. The number of 3, repayment capacity. This enables the institutions to ascertain whether its client business is in the positions to pay the loan back. It's important to note that repayment capacity must be calculated on the current business. Current business activity of the clients before assessing the loan. The number of 4, price hike in foreign goods, and it normally affects importers whose capitals reduces good after goods are sold of the foreign exchange. The number of 5, other business owned by the clients aside the one to be funded to avoid diversion. The number of 6, the credit history that the client has with our other financial institutions, which can determine the client payment habit aka credit score. And the number of last 7, microfinance companies must also inquire about their client mode of transferring money of the purchase, especially importers. The number of 2, commercial risk. Commercial risk also important to consider before granting a loan as a microfinance firm. Commercial risks that though to be considered by microfinance companies included. The number of point 1, the seasonality of the product or source of supply. This reveals how regular clients get is hard goods and their impact on the cash flow. The number of 2, replacers or assistant that handles client's business in his or her absence. This is very important, especially when the supposed client travels for stocks. Number of 3, the business owner's technical knowledge of the business. Most entrepreneurs have business such as hairdressings and other skilled trades without having the technical idea, and usually if their key staff resignate, their business come to halt, which affects their finances. The number of 4, stability of the business, and the number of 5, regulatory bodies approved for the various business must be requested by the microfinance institutions before granting loans. The next we see the collateral risk. Most microfinancing institutions require collateral to secure the facilities given, and it could either be a mortgage, cash collateral, or other fixed assets such as vehicles. Policies on collateral coverage vary from the institutions to another. It's important for a microfinance company to have policies on collateral coverage to ensure that all loans are secured in event of a default. The number of 4, client risk. This has to do with the individual accessing the facility or individual shareholders. If it's a limited liability company, the risk included. The number of 1, age. It's important that you only grant a loan a client within the age requirement of the insurance company that secures the loan of the financial institution. The way insurance claims can be paid in event of death. Secondly, an active client is able to perform his or her duties which generates more income. Most institutions grant loans to clients between the age of 18 to 60 years. And the number of 2, stability of the client. This has more to do with where the clients stay and whether resides mostly in the country where the facilities is taken. Okay, the number of 5, risk. The number risk, the name global risk. It's important for microfinance institutions to identify global risks for the business they fund. Global risk has to do with the risk involved when there is change in government policy, international trade, and the risk involved in the industry or sectors of the client. The microfinance sector should know government policies on the business they fund, since it can affect this business they are loaning money to instantly. Okay, the more instant the COVID-19 pandemic in the world has affected most business. Okay, the next last we finishes the conclusion. This conclusions means microphone companies have helped small business in most American countries because this business has little or no access to commercial banks due to the requirements. Microfinance institutions have also introduced the habit of saving among these interrupters with the saving app like PG Vets. In terms now save millions every month. However, for the microfinance companies to remain in business, it's appropriate for these risks to be identified in the business they fund and for measures to mitigate this small business risk to be met. Okay guys, this video I talking some informations know the risk before entering the loan and insurance industry. Okay guys, this video is helpful to you and informative to you. Please like this video and share your friends, and lastly subscribe to our YouTube channel.